So we are here because we want to meet as many investors as we possibly can. Quest does a great job at putting people here at the event. This event, I think, is great for first-time borrowers, first-time investors, and experienced investors. This event is great for finding funds that could fit their investment needs. I get a lot of business from the Quest event. I talk to people, I network with people, and it actually becomes business after the event.
Hello, and welcome to another episode of our Self-Directed IRA Saturday. We have a great speaker here with us today. Of course, he is no stranger to our stage, but real quickly before we bring him up, just going to run through a couple of quick slides. Of course, disclaimer. All the information that you hear and see today is for educational purposes only. If you do need expert tax advice, legal advice, we do suggest that you seek a qualified representative for that. So what's a self-directed IRA? Self-directed, of course, is just a marketing term. The self-directed part really lets you know that you get to choose your own investment with your retirement account in your IRA. We have 7 different types of accounts here, and if you do want to learn more about them, you can go to our education center, which I'll post in the comments whenever I bring Paul up in a second. But here at Quest, you can invest in all sorts of private assets like real estate, private entities, and promissory notes. Like I mentioned, if you do want to get an appointment scheduled with a certified IRA services professional, you can scan this QR code, you can speak to one of us, and we will get you taken care of. So my favorite part, we are hosting one of the biggest events that we put on here at Quest, the Quest Expo. And today we are actually going to be giving y'all 50% off for being a participant of this webinar today. So in the comments, I'll post that. But throughout this presentation, if you want to go to the website link that I'm going to post, grab your ticket. There is going to be loads of keynote presentations, panels, breakout sessions, and all sorts of fun, exciting things at the expo. So we really encourage you guys to come for the expo. Our promo this month is our rewards for deposits. You can earn up to $500 whenever you roll over or transfer money into your new Quest account, and you will get a free Quest Expo ticket. So if you don't want to open an account, you can take advantage of the other promo. If you would like to open an account and get a free Quest Expo ticket, that's a way to take care of all of it all at one time and make sure that everything's good to go. So without further ado, I'll go ahead and bring up Paul, who has a presentation today. He's going to be talking all about notes and lending. Paul, let's go ahead and get you on up here. I'll bring myself down and then you can go ahead and present.
All right. So is my PowerPoint on?
You're good to go.
Awesome. This is not going to work like that. Oops. I am so sorry. I've done countless of these, and for the first time ever, I don't have my PowerPoint clicker. And we're just going to have to make do without it. That's just all there is to it. And that's what I'm doing right now. So please forgive me. And just one more moment, and I'll be right with everybody. Okay, y'all are really awesome for letting me do that. Thank you, and my apologies. I will make up the time, I promise. So happy Saturday to everybody. Thank you for joining. For those that don't know me, this is a little about me. I'm a husband and father of 3. I am a 4th-generation real estate investor. I own residential properties, both commercial and abroad. I've been doing this for 20 years, lending money, that is, and I've been doing it as a residential and a private money lender. And so the intention today, and I've closed a whole bunch of loans, that's the last. The intention today is to learn things and put them towards our private lending. Utilize the tools that you learned today. So by a virtual show of hands here, who believes this slide to be true? Okay, it's a half truth is what it is. Knowledge by itself is not power. I know Valentine's Day is on February 14th. Yet if I don't take action behind that knowledge and take my wife to eat, buy her flowers, chocolates, be sweet, all that, well, then the knowledge behind knowing Valentine's Day, it means nothing. So this is my invitation to you. I promise no matter how long you've been lending private money, there are going to be some nuggets and takeaways that you get today. And my invitation to you is to actually apply those to your business as opposed to, well, just knowing it's Valentine's Day. So this whole presentation started, I was at a Quest networking event. I'm in the room, I'm talking to another private lender, and part of my business is I lend money to real estate investors, and then I sell notes to private lenders. And so when one conversation I'm having is I'm having a conversation with the borrower, and then another conversation I'm having with the lender. Well, at this particular Quest event, I was having a conversation with a private lender, and I was telling them about a note that I had to sell. And I just noticed they had this glossy look over their eyes. And I said, hey, I won't say her name, but I said, hey, what's going on? It doesn't seem like you're interested. And she said, well, Paul, I don't care about credit scores. I don't care about assets. All I care about is the deal. If the deal's a good deal, then I'll lend on it. And I was just dumbfounded. I mean, of course you're only going to lend on good deals. Like, why as a lender would you ever lend on a bad deal? But if you're only going to lend on good deals, don't you want to match that good deal up with a good borrower to make sure the investment goes good? Because if you have a good deal, but you don't have a good borrower, well, that good deal is going to go bad. And this whole idea of, well, the worst thing that can happen is a foreclosure. Yeah, that is the worst thing that can happen. And this idea that you think that you're going to make a bunch of money on a foreclosure, you know, us lenders that do this in volume, we laugh at that because all of us have lost money on our deals before because you can lose. And yes, the worst thing that can happen is a foreclosure. So the idea here of us chatting in this presentation is to avoid the foreclosures. And what are things that you can do in advance to drastically limit the likelihood of that happening? And of course, we're only going to lend on good deals. All right, so I ask you, how long have you been saving? How long have you been making sacrifices, whether that's taking a 2-day vacation instead of a 3-4-day vacation, whether it's even taking a vacation at all, the car that you drive, when you go out to eat, the side of the menu that you order on, how many sacrifices have you made over time, and how long have you been saving? Most of us, I'd venture to say, have been saving for decades. Now, couple all that discipline that you've had over these decades of savings and pair it with one lending mistake, and boom, all of a sudden the money's gone. I had a foreclosure this year in which we ended up making well into the 6-figure range. So, well, I just said that. Now you're going, well, Paul, I thought you said the worst thing that can happen is a foreclosure. It is, because I've also had 3 others to where we lost money. So although you may have one that just goes absolutely wonderful and you make a bunch of money, if you're lending, it's only a matter of time till something happens. So when you're underwriting and when you're approving these deals, just in the background, go, how long have I been saving? And is it worth me risking all of that time and all that effort and sacrifice for this deal to possibly go bad? I don't know. All right, so there's 2 things when lending, right? There's the guarantor and there's the collateral. The guarantor is a noun, a person, organization, or thing that provides a guarantee. A collateral is something pledged as security for repayment of a loan to be forfeited in the event of a default. And so we have 2 things here. A lot of times I have borrowing clients come and say, hey, wait, why are you asking all this information about me? I thought it's just based on the property. If the property qualifies, hard money lending is good to go. Not so fast. The loan is approved based on you. You, the investor, the borrower, are who qualifies for the loan. The property is merely security that collateralizes the loan. So loans are always approved based on the guarantor, and then they're secured based on the collateral. Both need to line up in order to have a successful loan and lending experience. All right, so with guarantors, what are we looking at? With a guarantor, we're going to look at credit, we're going to look at assets, we're going to look at income, we're going to look at equity in the deal, and then we're going to look at the experience and exit strategy. Sorry, let me say that again. We're looking at credit scores with guarantors. We're looking at income, we're looking at assets, we're looking at experience, and we're looking at exit strategy. We're going to break through each of those. Today, we are not going to talk about property due diligence, how to run comps, how to look at rehab budgets. There is tons of information, I think, out there on that and lots of different opinions on it. Today, what we're talking about is strictly the guarantor. And why? Well, rewind the tape and go back to 2008. It wasn't the bad loans that created the mishap that we had, but it was the bad loans. Well, that doesn't even make sense. So clean that up, Paul. Well, what I mean by it wasn't the loans, it wasn't the fact that interest rates were on adjustable rate mortgages. It was the fact that there were no down payments. People with low credit scores were able to get a loan with no skin in the game. And when things went bad, what happened? They ran away. So now think, if you're a private money lender, why would you want to lend to somebody that doesn't have a good credit score and doesn't have any skin in the game? You are 2008 all over again if you're doing that. So today we're going to talk about the importance of credit, the importance of income, assets, experience, and exit strategy. So let's go through those. First, credit score. Look, at our core, our credit scores are numerical representation of our ability to do what we said we're going to do. Let me say that again. Our credit score, at its core, is our numerical representation of our ability to do what we said we're going to do. And when we're lending to clients that have higher credit scores, well, that means less risk for us. And if we're lending to clients that have lower credit scores, that's more risk to us. And we want to balance the risk, of course. People with good intentions make promises, but people with good character keep them. I want to say that again. People with good intentions make promises, but people with good character keep them. You want to be aligned with clients that have good character. Does life happen? Yes, it does. I have a friend of mine who has an amazing credit score. He is just a man of his word, went through a divorce, didn't plan on it. Through the divorce, his credit got banged up a little bit. That doesn't mean he's a bad guy. So it's credit score, but we also want to peel back the onion a little bit and see what's behind the layer. Because often I have someone come up to me and say, hey, Paul, I lent to someone, they have an 800 credit score. High five for asking and going with it. Now, we dig a little deeper. They're 21 years old, and they got credit cards based on mom and dad's credit. Smart, got brought up in a good household, but that's a different score than, let's say, someone that's 55 years old with a 680. So, again, the credit score is the first layer, and now we start to peel it back. So every now and then, I have a real estate, every now and then I have a private money lender that says, Paul, I can't ask the credit questions. It's too intrusive. It's too personal. I just can't do it. I'm going, are you kidding me? You're about to lend hundreds of thousands of dollars to someone that you barely know, and you think it's too intrusive to ask them for their credit score. They asked you for hundreds of thousands of dollars. Think of the time that you've gone and got a loan from a bank, whether it's hundreds of thousands of dollars or whether it's tens of thousands of dollars, buying a car, getting a mortgage, applying for a credit card. Your credit score is pulled. So don't, as a private lender, skip that part thinking you're smarter, you're above it because you protected yourself in the deal, when that is just such an easy indicator of how the deal is going to go. So if you are that way, at least ask. And this is how you ask. Mr. Client, Mrs. Client, if you had to rate your credit from a 1 to a 10, 1 being the worst, 10 being the best, where would you rate it? And what you're looking for here is obviously the answer, but part 2 is the important part. And part 2 is this: whatever number they give you, what's keeping that from being 1 or 2 points higher? So for example, Mr. Smith, what's your current credit score? Mr. Smith, if you had to rate your credit from a 1 to a 10, 1 being the worst, 10 being the best, where would you rate it? He says an 8. Your follow-up question to that is, well, what's keeping you from being a 9 or a 10? And now you start to get the information that you want to know. Well, I co-signed for my son's car. He was late. Or, well, I have some credit card debt that's piled up. Or, well, I recently bought a car. Whatever the story is, you get to hear it. So those 2 questions, super important. Again, if you had to rate your credit from a 1 to a 10, 1 being the worst, 10 being the best, where would you rate it? And the second follow-up to that is, What's keeping you from being 1 or 2 points higher? All right. If you don't want to pull credit, if you don't want to ask those questions and you just want to send them to a website to have their credit pulled, the websites are creditchecktotal.com. So creditchecktotal.com. I believe they charge $1 to pull the credit report. I could be wrong. And then annualcreditreport.com. Again, annualcreditreport.com. All right. So why is credit important? It establishes my loan to value. Am I going to go to 70%? Am I possibly going to entertain 75? Do I need to lower my loan to value? Because I'll lend on a good deal. I'll just make it better if the client's qualifications aren't where I want them to be. So as a private money lender, if the borrower is not fitting your guidelines, by the way, I use borrower, client, and investor interchangeably. So if the borrower doesn't fit your guidelines and you think the deal is risky, lower your loan to value. Because go back to 2008. How did they fix the problem? They fixed it by requiring down payments. It hasn't been until recently, different conversation there, to where you've been able to get 100% financing unless you're a veteran. So 2008 has a problem. We're lending money to people that have low credit scores and we're not having them bring any money to closing. Now we're private lenders. What should we do? We should lend money to people that have good credit scores. We should still ask them to put money down. And if they don't have good credit scores, we should ask them to put more money down. That's what you should do as a private money lender. Income. Why does income matter? Well, income matters because it tells me what the backup exit strategy is. I want to say that again. Income matters to me as a private money lender because it tells me what the backup exit strategy is. We have clients come to us. They want to do a fix and flip loan. We analyze the deal. We lend the money. Everything's going great. Now it comes time to sell the property, and whether the investor wants to keep it because now they see that the market's increasing and they want to ride the appreciation. Maybe they want to get to a year and a day to limit their capital gains tax, or maybe the market's decreased a bit and then instead of selling for less than they thought, they want to ride out the storm, if you will. In either case, when I know what the income is in advance, I know what the backup exit strategy is. So the backup exit strategy, of course, is now they want to keep it as a rental. Well, there's 2 loan types that are available to investors and then hundreds that go under the 2 loan types. What are the 2 loan types? First, loans that are based on your personal income as an investor. Second, loans that are based on the property income as an investor. So as a real estate investor, you have 2 options when it comes to, where do you want your loans to start from? Do you want them to be based on your personal income, or do you want them to be based on the property income? Now, the answer to that goes to, well, what's best for you and what do you qualify for? What's best for you is better terms. Well, lending gives better terms based on lower risk. So if you're someone that can qualify for a loan based on your personal income, then you're deemed as a less riskier client. Therefore, your terms are going to be better. Now, if you don't qualify for the loan based on your personal income, not that big of a deal. The hiccup is you just don't get as good of financing. So what does that look like? Anywhere from 0.5% to 1% higher. Sometimes the rates can be pretty close to even, but the loans that are based on property income often come with a prepayment penalty to get the rates even. So when you're looking at a loan that's based on the property's income, meaning the lease agreements and the rents of the property, always beware of prepayment penalties, because you could think you're putting yourself into a good loan today, only to find out that you have a prepayment penalty for the next 5 years. And if rates drop in 2 years, the only way that you get to take advantage of that is by paying the prepayment penalty. And what is the prepayment penalty? It's usually called a step down. And a step down means this: the first year of a 5-year prepayment penalty, you have a 5% prepayment penalty of your loan balance. So if you've borrowed $300,000 and you decide to refinance or sell your house within the first year, what happens there is you have to pay a 5% penalty. 5% on $300,000 is $15,000. It's a lot of money. Now the step down is year 2, it's a 4% prepayment penalty. Year 3, 3%. Year 4, 2%. And finally, year 5, 1%, nothing after. So even if you don't refinance it in year 1, instead, rates drop in 2, 3 years. And in year 3, you refinance it. Well, now you have to pay a 3% prepayment penalty based on the loan balance that you have, which is going to be anywhere $9,000 or a little less. So beware of those as just an aside as a borrower. All right, now conventional financing, this is the best of the best. It's based on your property income or your personal income. So when I know what the investor's income is, it lets me know what the backup exit strategy is. So if things don't go as planned, or if the borrower wants to keep the property as a rental, I know what loan types they qualify for. Therefore, it helps me expedite that loan and therefore get my money back. All right, third, what I look at is assets. Assets to me, by far the most important. As a lender, you want to lend money to people that, quite frankly, don't need to borrow your money. They're looking to leverage their money with your money so they can do more deals or grow their revenue. And so we're looking for people that have assets, and not just because, well, the loans go better. Well, because the loans go better. So we found, obviously, that when people have assets and if something goes wrong with the remodel, so rewind. We've got a client that just closed on a fix and flip. And while they're tearing out the sheetrock, they found out that the electrical is faulty. If they don't have liquidity, they're going to call us, the private lender, and say, hey, we ran into a problem and we don't have any money to fix this. We need you to give us more money. Now, us as a private lender, we have no option really, because we can say, no, you figure it out. But what happens as time goes on? Well, time goes on, contractors go away, work's not being done, time kills deals. So now things can start going wrong. So if we don't give money to fix the electrical, we're at jeopardy for having our investment go bad. If we do give money to fix the faulty electric, which is what we're going to have to do, now we've over leveraged ourselves. So that 70% loan to value now is all of a sudden 72, 73. And guess what happens once they start doing the plumbing and they figure out the plumbing needs to be redone? Or guess what happens when the roof needs to be redone? Or guess what happens when they can't make a payment? You have to float them now. Because if you don't float them, you have to take on attorney fees. My recommendation is don't do that. Immediately file foreclosure and move forward. You've got to start the clock and you need to get your funds back. You're lending money. The harsh reality and the harsh truth is you will have to foreclose on somebody if you're doing it consistently for a period of time. And that's what you signed up for. So don't hesitate to do it when the time comes that it has to be done. You're only going to lose more money. It's only going to cost you more. Take it from somebody who's done it a few times. It never turns out good. Never have I given a client more time and it's turned out good. All right, so what are assets? Well, assets are cash. Assets are checking accounts, savings accounts, IRA accounts, 401k accounts, money market accounts, stock accounts. What an asset is not is a paid off car. What an asset is not is equity in your house. What an asset is not is a free and clear boat. Those things are great. And yes, they do have value to them. But us as a lender, we don't want to wait on someone to sell their boat, which they're unlikely to do, to get the money out to pay for the electrical that went bad. We want them to have the money aside. And if something goes wrong, they don't even bother to call because they know that this is a change order and change orders are processed outside. It's just the hand that's dealt to us real estate investors. Every now and then surprises come up, but we need to be in a position to where we can handle them, of course. And us as lenders want to lend money to clients, borrowers, and investors that have the rainy day fund. What's going on here? There we go. All right, so how do we verify assets? Well, quite frankly, we just ask for bank statements and we ask for IRA account statements and we ask for 401k statements. And God you trust and everybody else you verify. If you're lending money and you're not asking for bank statements, your degree of confidence and trust in that borrower has to be impeccable with a history of performance. I want to say that again. It has to be impeccable with a history of performance. Now, history of performance doesn't necessarily have to be doing fix and flips with you. I have a few friends that I've known since high school that do fix and flips. I'm not going to ask them for their bank statements. I know their character for 25, 30 years now. I see the projects that they have going on. I know their wives. I know their children. So for me to ask for a bank statement in that case, well, I've already worked with them. I don't need to. But first-time clients, always. And again, in God you trust and everyone else you verified, just ask for the bank statements. All right, why are assets so important to me? Well, because assets tell me whether or not I'm doing the deal. I don't know if you remember the scene from the movie Gladiator. Joaquin Phoenix is up there and he's going to put his thumb up or his thumb down, and it's whether or not we're going to kill Gladiator. Well, assets is exactly that. Do you have them? We're doing the deal. Do you not? We're axing it. We're moving forward. We cannot risk the sacrifices that we've made for decades and decades and to put us in the place that we've put ourselves in, to have it go bad on a deal that we're taking a chance on. It's just not smart lending. All right, so what's experience? Experience is knowledge is like a bunch of dots on the wall. Experience is like connecting those dots, right? So experience, I like lending to clients that have experience, not just flipping or doing renovations, because most of our clients never had experience before they came to us. We work with a lot of first-time real estate investors. So what experience am I talking about? Life experience. Somebody who's gone through life, is in their mid-30s, 40s, 50s, is looking at taking this on, has been self-employed since their early 20s, then now are in their mid-20s and looking to expand their business. Where's your experience? What I don't want to do is lend, and forgive me if you have a nephew that's like this. What I don't want to do is lend to someone fresh out of college whose mom or dad put them through a real estate investment seminar, to who are now going to go out and do fix and flip properties because, well, their liberal arts degree is no longer working out. So I want to lend to people who have been, well, battle tested in life, for lack of better terms. And if that recent college graduate who no longer wants to pursue their liberal arts degree, but rather wants to be a real estate investor, has a good deal, and I see the risk is okay there, I'm going to do it. But I promise I'm not going to do it above 65% loan to value. I would limit my exposure, because if something goes wrong, and heaven forbid I do have to foreclose, well, I've built in enough of a padding there to where I want to make sure that I'm paid back. So each scenario presents itself different terms. I was on the phone yesterday with a friend of mine who's a real estate investor and realtor. She's looking at building 2 duplexes. She wanted the absolute certainty on what the terms were going to be. I said, Ty, you don't even have a lot selected yet. I can't tell you what your terms are going to be with certainty, because you may buy something in Rosenberg, you may buy something in Conroe, you may buy something in Katy, you may buy something in the Houston Heights. So depending on where you're buying these properties, me as a lender, I want to mitigate my risk, because it's my money I'm lending. All right, how can you prove experience? You can ask for HUDs. A lot of national lenders will do this. They will ask for HUD statements that show how many transactions you've completed or your borrower's completed. So for example, if you're looking to have an investor or have a borrower prove their experience, you can simply ask them to provide their HUDs from the buy side of when they bought the properties and the sell side to when they sold the properties. And so long as you see both entities on there, you know this entity bought it, this entity sold it. Now, don't get fooled into getting HUDs from an entity that your borrower doesn't even own and is now going to say, well, I'm going to close it a different entity. Because what will happen is they'll present you with HUDs that belong to an entity that they're not a part of. So another way to check that is to put public records. You can go there and you can look up deeds of trust, put in their entity name, and it'll pull up a history of how many transactions they've done. I don't require our clients to work with contractors who are licensed, bonded, and insured and have a profile with the BBB or have Google reviews, but I highly encourage it. And I understand that a lot of contractors don't have that. Maybe not a Google presence, maybe not a BBB presence, but they should carry insurance. They should carry workers' comp insurance. They should be insured. I'm here in Texas. You don't have to be licensed to be a contractor here in Texas. But if you're outside of Texas, you want the contractor, of course, to be licensed. Why would you have a house that you own get worked on by a contractor who's not licensed and subject yourself to, well, challenges. All right. What is the number one question private money lenders should ask? The number one question a private money lender should ask is, how do I get my money back? Another way of asking that is, what's your exit strategy? Exit strategy to us private money lenders simply means, how do I get my money back? And as a private money lender, you never, ever, ever want to start a loan conversation or a lending conversation without knowing what the exit strategy is. And quite frankly, that just takes place at the beginning. What are you looking to do? Are you going to fix and flip this property, or are you looking to keep it as a rental? If they're going to fix and flip it, you better know about days on market. And if they're going to keep it as a rental, you want to know in advance if they've started looking for the exit loan. I have come across tons and tons of investors over the years who call us after they've gotten a private money loan somewhere else, telling us they now want to refinance it into a long-term loan and have no possible way of obtaining long-term financing because they have credit challenges from before that simply can't be overcome for an investment property purchase. So now they're stuck in a 10, 11, 12, 13, 14% interest rate loan. The private lender's on the other side complaining, saying, wait a minute, I only lent you this money because it was supposed to be a 6-month loan. We're in month loan 9 now. I want my money back. The investor's going, I can't refinance out of it. I don't qualify. The private lender's blaming the investor, saying, hey, why didn't you know this in advance? When that's not who's to blame. Who's to blame is the private money lender, because you should never, ever, ever do a loan without knowing your exit strategy of your client in advance. And if they want to keep it as a rental property, you better ask them their credit score question, because that credit score, it's on all of our apps. Any credit card that we have, we know what our credit score is. And when you have bad credit, you know you have bad credit. So asking for the credit score is so important, because not only does it tell you how likely your client is to perform on this investment, especially if things go bad, because everybody goes right when things are right, and everything is right when it's right, but it's not right when it goes wrong. And when it goes wrong, people with good credit scores have a history of staying in the game and making it right. People with bad credit scores, the reason they have a bad credit score is because they couldn't keep it right. So now tie that to your exit strategy. If you have a borrower that you're lending to that has a good credit score, the likelihood of them being able to refinance out of your loan and get you paid off is far greater than someone that doesn't have a good credit score. So again, the number one question us as private money lenders need to be answering and asking is, what is your exit strategy? AKA, how do I get my money back? I love this quote by Mark Twain. It's not return on my money I'm interested in. It's the return of my money. So before us as private lenders start counting all the money we're going to make if this deal goes right, first, let's make sure we're going to get our money back, because it's not the return on my money I'm interested in. It's the return of my money. Once I get it back, now let's talk about my return. So I need to be very diligent in whom I'm giving my money to make sure that first I'm able to get it back, and then we can talk about the profits afterwards. And when I say then talk about the profits afterwards, I don't mean my borrower pays me what I lent them and then we can talk about the interest on top. I mean, my number one concern is getting my money back, because that quote by Mark Twain, it's not the return of my money it's not the return on my money I'm interested in. It's the return of my money I'm interested in. What that tells us is our first foremost thought needs to be on the security of our investment, not on the profits of our investment. Look, if you have questions, texasnotes.com is a website there. We have two entities, Blink Lending and Investments. That's our client forward-facing company. That is the company we do all of our marketing under. Texas Notes is who does our loan servicing and who sells our notes. So if you go to texasnotes.com, I have information about the note private lending, your underwriting process, guidelines that you should follow. Also, I have closing docs on there, and from our entire closing doc package to exactly how we send it to the title company, to our loan purchase agreements, our transfer and assignment of liens. So if you're ever just looking for resources, you can go there. And of course, if you're interested in having a conversation or learning about our note selling process, I'd be happy to do that as well. Speaking of which, this is how we send out our private lending opportunities. And so if you want to join our private lender network, our distribution list, simply send an email to hello@texasnotes.com saying add me. Go to our website, texasnotes.com. You can sign up there. And what we do is we put you on an email distribution list that as we have private lending opportunities, we send those to you for you to review. If you like it, say I want to buy it, and then you get to buy the note. It's that simple. What information do we send you? Well, we're going to send you information about the deal first and foremost. We're going to tell you its address, its purchase price, the rehab budget, the after repair value, and the terms of the loan. We're then also going to tell you the returns that we're giving you. We typically pay between 7 and 9% on our notes, depending on the amount you have invested and depending on the note itself. Our distributions are paid monthly by the 15th. It's been a long time since anyone hasn't gotten paid by the 8th. So classic under promise, over deliver. We then give you information here about the borrower, the guarantor, the person that's signing the document that says, I promise. See, when someone's signing a document that says, I promise to pay you back, we need to make sure that that signature means something and is worth something. So we tell you about the guarantor. Then we give you some more information. Here's another deal, another example. And then there's the information that we give you there as well, again, about the borrower, about the property. So you're able to make an informed decision as to whether or not, you want to purchase a note. All right, again, this is our list. It's hello@texasnotes, or just go to texasnotes.com. Guidelines. What are your lending guidelines as a private lender? Do you have lending guidelines as a private lender? If you don't have lending guidelines, why don't you have lending guidelines? You're a private money lender. You should have guidelines. And they're exactly that. They're guidelines. They're not red, green. It's just a guideline. All right, so I know that there's a private lender on this call, on this webinar right now, and I know what they're thinking is, I don't care what you have to say about credit. I don't care what you have to say about income. I don't care what you have to say about assets. It makes sense, but I still only care about the deal. If the deal's good, I'm going to lend on the deal. Well, good for you. I have a question for you. If you ask those questions about their credit, their income, their assets, and you know they're not as good as they should be for a guy like me or other lending companies out there, don't you think you can charge more interest, more points? Because aren't riskier deals, don't they deserve higher terms? And don't less riskier deals deserve better terms? So if nothing else, selfishly ask the questions to properly determine what your return should be. Because I work with a lot of private lenders that have flat fees. They go, I charge 12 and 2. That's what I charge, period. 12% interest, 2 points to everybody. And I just can't wrap my head around that. I said, wait a minute. So somebody that has a 510 credit score gets the same terms as someone with an 800 credit score. And they go, yes. And I go, okay, let me ask again. So somebody that has $10,000 in the bank is going to get the same rate as someone who has $500,000 in their IRA and $150 in their checking account. And they go, yes. And I okay, that's their business. That's up to them to run it. I will tell you, the people with higher credit scores and higher assets amounts, they don't like being nickel and dimed. They are savvy, financially savvy, and they're going to shop and get the best loans. So have your terms match that of which attracts the borrowers, investors, and clients that you want. Let me say that again. Have your terms match the borrowers, investors, and clients that you want to attract so you can lend your money to. All right, market update. Look, interest rates, if you're buying a home to live in, you can get in the mid 6s to low 6s. If you pay a few extra points, you get in the high 5s. Investor rates, you're looking at 20% down, you're about at 8.25. If you put 25% down, you're getting into high 7s. If you're putting 30% down, you're getting into low to mid 7s. So rates, that's where they are right now. And those are for 30 years, and it's just a roundabout. If you are interested in getting an exact interest rate for a house that you're looking at purchasing or refinancing or cashing out in, and you don't want to talk to a loan officer, what you can simply do is go to our website. It says get a quote. Click on that. Just fill out it takes maybe 30 seconds to fill in the blank form. Basic information. we get your, we'll send you a quote via email. As a private or hard money lender, never ever forget the golden rule. And the golden rule is simply this: he or she with the gold makes the rules. So it's you as a private lender that makes the rules. It's you as a private lender that gets to pick the attorney that's going to draw up the loan documents. It baffles my mind how many times I hear horror stories of a private lender that used the borrower's attorney to do the loan documents because, well, the borrower just made it easy on me. Are you kidding me? You want a third party doing the documents to ensure, one, they're done properly, and two, that they're recorded properly. I am not making this up when I tell you I have lent money to a client before who got a second lien, and the second lien loan docs were done in our name. So the attorney that the borrower hired for the second lien private money lender put us as the lender in the second lien position. They didn't even find that out until well after the fact. At payoff, we get back, well, what's your second lien payoff? We're going, second lien? We don't have a second lien. Yes, you do. Showed us recorded documents that we have a second lien. Luckily for the private lenders, we researched them, called them, and said, hey, you just almost had something go really, really bad here because you didn't even record the documents in your name. Like the lender name wasn't even their name. I can't make this stuff up. It happens. Protect yourself. He or she with the gold makes the rules. It's your responsibility to make sure that you're lending properly and that you're making smart loans. And if you have questions about that, reach out to myself, reach out to any other lender that has experience. For the most part, all of us love to help out. And as lenders, we have it into where we don't want anybody to lose money. So you'll be surprised how many people are willing to help. All right. Do we have any questions or are we done? Who's awesome? You're awesome.
We are done. I don't think we have any questions. But that was a really, really, really good webinar. Appreciate that. I learned a lot. And yeah, if we do get some questions, we'll be sure to send them to you. And
perfect.
Yeah.
Well, if anybody has any, if you have any questions, feel free to reach out to me on my cell. My cell phone's 281-221-7383. My email is paul@blinklending.com. That's blink like blink your eyes, lending like lending money, paul@blinklending. Also, Ravi Kaku's information is here on the slide. He and I really head the fundraising for Blink Lending and for Texas Notes. And then we also have the whole back team that really makes the magic happen. But if you have questions and I'm not available, Ravi's available to you. His number, of course, is 512-653-2858. Lastly, my number, 281-221-7383. Y'all have a great weekend. Sarah, thank you for having me. Oh, and if you have not purchased your expo tickets yet, I am terribly saddened that I'm not able to make it, or else I would be there. Why am I not able to make it? Well, I'm taking my family and we're going to Greece. And we're going to be gone in Greece during the expo. And Ravi's going to be in London when the time comes. And then I could just go on and on about, we're just out. It's awful. Quest next time should pick, well, enough of that. The point is if you haven't got your ticket, it is an awesome, awesome, awesome expo. The speakers are great. You meet local, down-to-earth people. There's borrowers there. There's investors there. There's private lenders there. There's attorneys there for documents. There's survey companies that are there. There are realtors that are there. Like, if you are looking to meet anyone really in the real estate investment space, that is a great place to go. And I think, Sarah, you said you're doing a 50% off promotion. So
we sure are. Yep. Be sure to use this coupon code, and we will get you taken care of. We do have a couple of questions, if you have a second, from the webinar.
Yeah.
Okay, cool. So Kevin asked, what about lending money to funds that make private loans?
Lending money to funds that make private loans. So, Kevin, I don't know if you're going to like my answer, Kevin. Pools are for fools is something that I've grown up professionally being taught. And when you're lending money to a fund that is then lending money based on properties, you as an investor and as a private money lender, you're really signing a bunch of documents that say, if something goes wrong, well, sorry, you lost your money. And too bad, so sad. When your money is spread on multiple properties, well, then your recourse isn't there. It belongs to the fund that you're giving the monies to. Well, if the fund is mismanaging things, that means if they're mismanaging your money, they're likely mismanaging other money. And now what happens if your money is mixed in with 10, 20, 100 other people's money that the deal went bad? All of you have put in $5 million, but the hedge fund was only able to get back $3 million. Well, that's a $2 million delta there. The hedge fund's not going to have the money to make that up and to make you whole. So when I get asked questions about, hey, Paul, do you think it's a good idea to lend money to a hedge fund or a fund that's now lending money in first lien positions? I say no, because your money is spread out over multiple properties. And if things go bad with that hedge fund and they lose cash, who's to say they're going to pay you back and not pay somebody else, or pay somebody else and not pay you? The difference in our process is we sell single notes. So your money is going directly to a note. And then I'm servicing your loan, Kevin. And if you want to fire me because you just don't like me for whatever reason, well, we can go to county public records that say you own this note. So not pools for fools. You own an actual note that you can say, my money is tied here. It's highly unlikely right now that you can tell me where your money is tied to. And this isn't me scaring you or trying to put fear into you. It's reconsider. I'm always baffled by the people that sign the documents that say, if anything goes wrong, you lose your money, and then it's a safe investment. No, it's not. The minute you sign a document that says if something goes wrong, you lose your money, like, hello, something could go wrong, as opposed to investing in items that have personal guarantees behind them, are secured by an actual first lien real estate position. And in our case, with our notes, we also sign a company guarantee on top. So if, let's pretend you or someone buys one of our notes and our note stops performing, well, you never get a phone call that says, hey, Kevin, sorry, we're not getting payments on this. So, we'll just call you in a few months to tell you how it goes. Instead, it looks like this. Hey, Kevin, you're going to get an email later this afternoon from our attorneys. Our attorneys are sending a demand letter to our borrowers on 123 Sesame Street, the note that you have. Nothing for you to do, just keeping you informed as to what's going on, because last month they didn't make the payment, and we, of course, want to proceed with our foreclosure. You're going to continue to be kept updated throughout the process, and, of course, continue to expect your payments. Often, Kevin goes, wait a minute, but I got paid last month. I know. Our agreement that we have says if the borrower doesn't pay, we pay. So you, as our note buyer, never skip any payments. You never skip any receipt of payments. You continue to get paid every month by the 15th. We pick up all of the attorney costs. We handle all the recording fees, all the title fees, to do the nothing further lien searches to make sure that nothing surprising has popped up. If the client files for bankruptcy and that delays our foreclosure, we continue to incur those attorney costs. We continue to pay you your monthly distributions. And then if the property gets sold at auction, well, we all get paid back and you get paid back. If the property doesn't get sold at auction and we take the property back, what happens is we call you and say, hey, Kevin, you've got one or two choices. Do you want us to cash you out and give you your money back? Or do you want to continue earning interest that you've been earning interest on? It goes either way, depending on how Kevin feels. But the big difference here is you have a personal guarantee from our client. More often than not, we have our clients that are partnered up, so we have multiple guarantees on our loan. Then you have our company guarantee afterwards. And if anything goes wrong, what the company guarantee says is we pay everything. And that's on our website at texasnotes.com. Upper right corner, it says examples. Click on examples. Then it says loan purchase agreement. Click on loan purchase agreement, and you'll see all of our agreements that we have there. Right next to it's our transfer and assignment of lien document. And that's the document that gets recorded in a first lien position. That is the big differentiator from anything else that you're likely doing, which says you own that note. So if anything goes wrong, knock on wood, public record has you owning that note, which is drastically different than having your money set up in a fund. Sorry for the long-winded answer, but I hope that made sense.
Yeah, no, definitely. It sure did. Yep, definitely. So yeah, this was a great webinar. All the presentation will be recorded. So we're good there. And yeah, I really appreciate everyone for joining today. Thanks so much. And yeah, we'll see you next time.
Have a great weekend, y'all. Cheers.